Hi friends, welcome to Amazon World. So in today's video, I'll be continuing with the questions, the illustrations of retirement of a partner. Okay, let's continue with illustration number 17. We did illustration number 16 till in the last video. Now in illustration number 17. So now let's start with illustration number 17. On 1st January 2010, A and B started a firm of cost accountants sharing profits and losses equally. Okay, so I'll be writing down the informations in a piece of paper like this. Okay, so that is going to help me. I know this is not, this is actually one side paper. I just don't want to waste it. Okay, so let me write it down on this piece of paper. Okay, so it is in the 1st January 2010. A and B started a firm, right? So who are the partners? Partners A and B. Okay, started a firm of cost accountants sharing profit and losses equally. So their profit sharing ratio is 1:1 because they are sharing the profits and losses equally. Hope you got the point. Now each of the partners contributed rupees 2,000 towards his capital of the firm. A and B, both A and B have contributed rupees 2,000. That is, A contributed his capital 2,000 as well as B contributed rupees 2,000 and was allowed to draw rupees 400 per month. So per month they are allowed to draw 400 rupees 400 in anticipation of profits. Okay, so when profits arrive, they are allowed to draw rupees 400 per month. So rupees 400 per month and here rupees 400 per month. Then, on 1st January 2011, they admitted C as a third partner with equal share and he contributed rupees 3,000 towards his capital and a further of rupees 2,000 towards premium for goodwill. He too was entitled to draw rupees 400 per month. Okay. January 2011. 1st January 2011, partners, new partner came, right? C, a new partner named C K. So now total partners are A, B and C, right? And their profit and loss ratio is also 1:1 since they are sharing the profit and losses in equal. They have said it, they have mentioned it there. And this B, sorry, the newly arrived partner, that is C, has contributed rupees 3,000 towards his capital. So A has rupees 2,000 capital here and B have rupees 2,000 also capital. Now C's capital will be mentioned here. C's capital is rupees 3,000. Okay, so this is capital and his goodwill. C's goodwill is of rupees 2,000. Goodwill premium. Okay, goodwill premium is of 3,000. Okay, then he is also entitled to draw rupees 400 per month. So rupees 400 per month is allowed to draw. Okay. Now reading further. From 1st January 2012, A got a part-time job of cost consultant elsewhere and considering that he would be unable to devote his full time towards the business of the firm, agreed to leave half of his share in the profits to be apportioned equally between B and C and his drawings was reduced to rupees 200 per month. Here, that is something you have to focus. From 1st January 2012, okay, let's write it down first. 1st January 2012. What happened? A got another job, right? A got a part-time job as of a cost consultant somewhere else. And since he's got a part-time job, he is not able to devote full time into this firm. Okay. So what is happening here? Agreed to leave half of his share. So what happens when such a situation arrived? A agreed that he is going to leave half of his share in the profits to be apportioned equally between B and C. That is, what is now A's share? A's share is 1/3, right? A's current share is 1/3. A's share is 1/3 now, right? Now he's saying that half of his share, right? Agreed to leave half of his share in the profits to be apportioned. So now let's take half of this share. So what will be the half of 1/3? 1/3 half will be like this, right? Which can also be written like this, 1/3 into 1/2. Now that is equal to 1 by 6. Calculated half of A's share, and this has to be apportioned, right? Apportioned equally between B and C. So B and C. Let's apportion this equally to B and C. That is 1 by 6, half, right? Again half B's share. B will get how much? 1 by 6 into 1 by 2. And C will get 1 by 6 into 1 by 2. That will be 1 by 12. 1 by 12. Okay, now B and C got 1 by 12, 1 by 12 from A's share. Now let's add this portion to B's and C's current capital. So B's current capital, so current share is 1 by 3 and C's current share is 1 by 3. So add this 1 by 12 to this 1 by 3 of B and C. Okay, so that will be their profit sharing ratio now. Okay, so what will be the profit sharing ratio of B and C now? That is after when A got a part-time job elsewhere, he agreed to share half of his profit sharing ratio, half of his share with B and C. So we took half of his share. So his share was what? 1 by 6, 1 by 3, right? So 1 by 3 is half, which is 1 by 6. And this 1 by 6 has to be apportioned to both B and C equally. Equally means half and half. So 1 by 6 half and 1 by 6 half. Again we calculated and we got 1 by 12 and 1 by 12. So this is the portion of A that is going to be beneficial for B, and this is the portion of A's share that is C is going to get. Fine. So what we have to do now, we have to add this 1 by 12 and 1 by 12 with B's and C's current share. Now like in 2011 both B and C had 1 by 3, 1 by 3, right? So 1 by 3, we have to add this 1 by 12 with 1 by 3 in order to get their total profit sharing ratio. So what will happen? 1 by 3 plus 1 by 12, 1 by 3 plus 1 by 12. Got it? Now what we have to do, we have to cross multiply, and finally we'll get how much? 15 by 36 here, which can also be written as 5 by, yeah, right, 5 by 12. Again here also 5 by 12 will get. Okay, so now what is their profit sharing ratio? Let's calculate that. We have to take this 1 by 6 from this 1 by 3 in order to get A's share. So now let's calculate again. In 1st January 2012, we have to calculate what is the profit sharing ratio of A, B and C. We got B's share, that is 5 by 12, C's share, that is 5 by 12. Now we have to get A's share because A already given 1 by 6 of his share to B and C. Okay, now let's find what is A's current profit sharing ratio. So A's share is what? A's share is now was 1 by 3 and he gave 1 by 6 of this. 1 by 6 of this, and he gave 1 by 6, that is half of this 1 by 3 to B and C. So we have to subtract, when we calculated half, we got 1 by 6 is the half of 1 by 3 and we have to subtract this half from this 1 by 3 now in order to get. So let's just cross multiply again and you will get, so we'll get how much? 3 by 80, which can also be written as 1 by 6. So when we are writing the profit sharing ratio, it will be what? 1 by 6 is A's share, B's was 5 by 12 and C's was 5 by 12. So this is their current share now. That is their share profit sharing ratio in 1st January 2012. Okay. Now let's calculate. Now let's read the question further. We haven't finished reading this. Okay. And what are they saying? That is A's like withdrawals is reduced to rupees 200 per month. So till 1st January 2011 he was allowed to withdraw rupees 400 per month. Now when he is going for a part-time job, since he already left his half of his share to B and C and he cannot devote full time to this firm, what is he doing? His withdrawal is also reduced. It was 400 before, now it is turned to what? How much? Rupees? It became rupees 200 per month. Okay, let's read further. On 1st January 2013, B got a full-time job and in consequence A had to leave his part-time job and to devote full time in the firm. So on 1st January 2013, what is happening here? B got a full-time job and in consequence A had to leave his part-time job and to devote full time in the firm. What is happening here is A and B was a person, were the people who started the partnership firm, and the first scenario was when A got a part-time job and he gave half of his share to B and C. Now the scenario is different. Now B got a full-time job elsewhere, so he is going to leave this firm. B is entirely going to leave this firm, and since B is going to leave, what should A do? A should come back, right? A should finish his, he should stop going to his part-time job. A should come back from his part-time job and should devote full time to this partnership firm only, since B is going, because now from now onwards B will not be giving any of his service to this partnership firm. Okay, so A has to leave his part-time job and has to come back. That is what they are saying. A had to leave his part-time job and to devote full time in the firm. It was arranged that B will remain only a quarter of his share in the firm. So what is happening here is, since B is going entirely, he is going out from the partnership firm, he is not going to come back. It is not a part-time job, it is full-time job that B got, so he is going to leave this partnership firm. So what it is saying, what they are saying that B has it was arranged that B will remain only a quarter of his earlier share. So what is B's share now? B's share is 5/12, right? So he is going to leave quarter. Quarter means 1/4 of his share in the firm, and would be drawing nothing from 1st January 2030, right? Like B had the entitlement to withdraw rupees 400 per month, right? It was only from 1st January 2012. A's withdrawal was limited. A's withdrawal got restrictions. So it was from 1st January 2012 that A got his withdrawal some restrictions. Till 1st January 2011, every partner was withdrawing rupees 400 per month. And from 1st January 2012, since A went to part-time job, his withdrawal was limited to rupees 200. Now, in 1st January 2013, we forgot to write 1st January 2013, right? So, 1st January 2013, what happened? B is going. B is leaving. We can also say is retiring. Okay. So, what is happening? A has to come back, and B, from now onwards, B is not going to withdraw anything, because he is going to retire, so he cannot withdraw anything. So that's what they are saying, that would be drawing nothing from 1st January 2013, and his quarter of his share he is going to leave in the firm. Quarter of his share. So B's current share is 5/12. Let's calculate quarter of his share. B's share is equal to 5/12. Let's calculate 1/4 of this 5/12. 1/4 of this 5/12. So that is going to be 5 divided by 48. Okay, fine. Let's read further now. Then A and C would be drawing at rupees 600 per month instead. So what is happening here? A and C has got a arisal in their limitation of withdrawal. That is, they can now withdraw now 600 per month. That is what they are saying here. The interest surrendered by B would be apportioned equally by A and C. That is, here we said that he is going to remain 1/4 of his share. That is, his share was 5/12. B's share was 5/12, and 1/4 of his share is going to remain in the firm. That is, 5/48 is going to remain in the firm. Okay, and what about the rest of the shares? Rest of the share will be, we are going to assume that they are surrendered. Okay, so if it is said in the question, if it is mentioned in the question that only this portion of share is being remained in the firm, the rest of the shares, that means the rest of the shares are surrendered. Fine. And it is meant to be distributed. So that is what they are saying here. That is, let's just subtract this 5/48 from this 5/12. 5/12 minus 5/48. We'll get, okay, so we'll get 180 divided by 576. So that will be equal to, we can again minimize this to 15/48. So this portion of share is going to surrender, and this portion will be equally distributed to A and C. That is what they are saying. The interest surrendered by B would be apportioned equally by A and C. On 31st December 2013, B decided to retire altogether from the firm. So it is on 31st December 2013, he is finally going to retire from the firm. So let's just calculate. 15/48 is to be distributed among A and C equally, right? So let's just calculate that. 15/48 into 1/2, A's share. B's will be 15/48 into 1/2, and we'll get 15/96 here. I'm just copying it down. Okay, 15/96 and 15/96 equally, right? We'll get, this is only this is only that small portion which is they are going to get from the B's share. Now we have to add this with their current share. So their current share was 1 by 6, A's share was 1 by 6. So let's just calculate A's share now will be 1 by 6 plus 15 by 96. And B's will be what? Like that only. 5 by 12 was his current share, that is 5 by 12 plus 15 by 96. We have to do this, and finally we will get what? 31 divided by, that is 31 upon 96 and 55 upon 96. So these are their current ratio. So now let's just write it down. 31 by 96 and 55 by 96. So these are the final, that is A's and C's. Okay, hope this is clear to you now. Now what we have to do, also note this date, that is 31st December 2030 is the day that B is going to retire. B is going to retire. Okay, so this is a date that is going to ultimately is going to retire on this date, 31st December 2030. Let's read the question further, because you are required to ascertain the amount due to B by the firm from the following particles. So like any other question of retirement of a partner, what do we used to find in capital account? We used to find what is that particular amount the partnership firm has to give this B, since it's going to be retiring from the firm. Okay, so that there are some conditions or some terms that you have to keep in your mind while you are calculating that. So that is what they're going to tell you now. Let's read that. Profits earned. They have given us 4 years profits. Now what we have to do? B's share of goodwill is to be taken at 2 years purchase. 2 years purchase. Yeah, note this down. Of the average of his share of profit of the previous 2 years. They have given us 4 years profit, and we have only to take previous 2 years. Previous 2 years means he was retiring on 31st December 2013, right? So previous year means 2012 and 11. We have to average this one, and then we have to multiply it with this 2 years purchase, and then you will get what? Goodwill. Okay. The partners have drawn exactly what they could draw under the agreement. Okay. Now we have to calculate. So these are the calculations which I already explained to you. I hope the explanations which I gave is clear to you. Okay, fine. Just go through the video once again after seeing this, and do this question by yourself. You will get to understand how to do this question. Okay, it is not that tough. Only the portion. This is the portion that you're going to get a little bit confused. Even I am confused because I am not able to give you a perfect explanation for that, because I searched for this topic everywhere and it didn't got a satisfied answer, and there were a lot of Hindi videos in YouTube, but stand what they were saying actually. So there were a lot of faculties were explaining this, I guess. Yeah, so I'm not able to give you a perfect explanation for this portion. That is 1 by 4th of A's share was remained in the firm, and the rest shares, that is what, 15 by 48, right? That has to be, they are mentioning here as interest, and I'm not sure about that topic. So if any one of you knows the clear cut explanation, please put that in the comment section. So that is going to help a lot of students. Fine, let's do the question further. Okay, now we are going to calculate goodwill. Okay, so goodwill calculation I will explain with the help of a study mat. It's just that I want to show this so that you will be able to understand. First thing I did was just writing down the facts and figures from the question given. In this question, like any other question of partnership accounts, they have not given us a balance sheet. Okay, so this question is a particular, it's a bit odd question. Okay, so let me continue with the calculation of goodwill now. So as I told you, they have specifically mentioned that previous 2 years, right? Let's see the question here. They have mentioned previous 2 years. B's share of goodwill is what we have to find, right? B's share of goodwill is what we have to find, and they have given us the entire profit of 4 years of that. Like they have given us a profit of the firm of 4 years, and we are only owed to take which 2 years profit only, 2011 and 12, since it is on 2013 December 31st B is going to retire. So we are only to take previous 2 years, previous 2 years from this date. So that is going to be 2012 and 2011. So let's take this 18,000 and 24,000. Fine. Now what we have to do? They are asking us to find B's share of goodwill. B's share of goodwill. So in order to get that, let's just find what is the B's share from this profit. So 18,000 is there, 24,000 is there. In 2011, what is B's share? In 2011, B's share was 1 by 3, right? And in 2012, B's share was what? 5 by 12. Let's just calculate it. That is 18,000 into 1 by 3 and 24,000 into 5 by 12. So we'll get what? B's share of profit we'll get. Let's just add them together then. Okay, so 24,000 was the profit of 2012 and 18,000 is the profit of 2011, and in order to get B's share of profit in 2011, we just multiplied 80,000 with 1 by 3 and we got 6,000 here. Likewise, in order to get B's share of the profit of 2012, we multiplied 5 by 12 with 25,000 and got 10,000. Let's just add this together and get 16,000. So this is the total annual profits of previous 2 years that B got. This is the B's share that he got from this 2 years. Fine. Now what we have to do? We have to average it, right? So we have to average it. We are taking how much years we take, how much years profit did we take? 2 years profit, only 2 years profit we take, because they have specifically mentioned it there, right? So previous 2 years, so 2 years profit only we took. So in order to average this, what we have to do? We have to simply divide it by 12, divide it by 2. If there were if in the question they asked us to take 3 years, then we have to divide that 3 years profits divide by 3. Since they have only asked us to find 2 years profit, we are dividing it by 2 in order to get the average. You all know the basics, right? It is simple. So we got 8,000. And what is that purchasing years that they are telling us? 2 years purchase is mentioned in our question. So just multiply this 8,000 with 2 again, and again we'll get 16,000. So this is B's share of goodwill. B's share of goodwill. Fine. Then they have not specifically asked us to do something. Let's just draw capital account, because like in normal questions they used to ask us to prepare balance sheet or capital account. They have not mentioned anything here. Partners have drawn exactly what they could draw under the agreement. Okay, now let's just follow our study mat. Our study mat has shown capital account here. So let's just draw B's capital account. They have not mentioned anything particularly here. So just in question paper and all, I guess there will be some specifications to what we have to draw, what we have to prepare. Okay, so now let's just go through this B's capital account. Okay, so what all things we have to mention in this B's capital account? Only B's thing have to be, only the partner B's things have to be noted down in this capital account. This is not a consolidated capital account, it's only B's capital account. You have to take a note on this. Okay, now what we have to do? We have to first show B's capital, right? So B's capital was 2,000. Okay, then what else? B used to withdraw 400 per month. Yeah, and in 2011 also he withdrew 400. 2012 also he withdrew 200. But from 1st January 2013 onwards, his withdrawal became nil. Right? Since he is going to retire, his withdrawal became nil. And on 31st December 2013, he retired. Okay. What all things we have to mention in this capital account? First thing we have to mention is the capital. Then we have to also mention, in the first year we have to mention his withdrawals also. Then the profit of, the share of profit he got. Everything has to be noted down in this capital account. I guess you all know that. So let's do that. So the first thing we are showing is 1st January 2010. It was on 1st January 2010 that these partners agreed on creating a partnership firm. And yes, they did that. And B's share of capital was what? 2,000. So that is what they're showing here. By cash, 2,000. His contribution. Then what came? Then withdrawals. That is 400 is per month. So into 12 you do it, and you will get how much? You will get 4,800. So 4,800 he is going to withdraw. That is 31st 12 2010. For 12 years we are calculating, right? So in order to calculate 12, that is 400 per month is his withdrawal limit. So let's just assume he is going to withdraw 400 every month. So at the end of the year, he will be withdrawing. Total amount of his withdrawals will be 4,800. How? 400 into 12. 31st 12 2010 is the date you have to mention here. That is right. Okay. Then what we have to do? We have to share the profit, right? His profit sharing ratio was 1 by 2 in 2010. So in 2010 they have given us, the question has given us the profit of 2010, that is 17,000. We'll be able to see here, right? 17,000. So 17,000 into B's share. B's share was 1 by 2. Let's just do that, 17,000 and 1 by 2, and we'll get that profit 8,500, and we are just writing it like profit and loss account. This is a share of profit he got. Then just total both the sides, and you'll get 10,500 as greater, and you have to write, you will get a balancing figure on the debit side 5,700. We have to write it as balance carried out. We are just brought forwarding it to the next year, 1st January. So that is a mistake. 1st January 2011. 31st 12 2011, 31st 12 2011. So by balance brought on, we are just forwarding the balance which we got, balancing figure which we got on the 2010s. So we are just transferring the balancing figure from 2010 to 2011. So we'll get that by balance brought on 5700. So we got 5700. Then what we have to do, we can see here we have already written the facts and figures from the question. 2010 over, now 2011 came, and 2011 a new partner came and he contributed 3000 as his capital and 2000 as his goodwill premium. So what we used to do with this 2000, we have already learned in the admission of a partner, when the new partner brings a goodwill premium, that will be shared among the old partners or the existing partners, right, old partners, and on their profit sharing ratio. So this 2000 have to be shared among B and A, right? But since we are only preparing B's capital account, there is only need to show B's share. So B's share, how can we calculate B's share? So B's share is what? Old profit sharing ratio is 1/2. So 2000 into 1/2, and we'll get the share of goodwill premium of B, right? So goodwill premium, share of premium, that is 2000 into 1/2, that will be equal to 1000. Just write it likewise. Fine. Then what is the amount of drawing? So don't forget to show the date. They have wrongly shown the date, so just please correct it. Okay. Now when it comes to the AR ending of 2011, he withdrew. Still he is going to have rupees 400 as his withdrawal. So there is no change in that. So 400 into 12, again he is going to withdraw 4800 in the entire year of 2011. We got that. Then what we are going to do, again write the date 31st 12 2011, because we have to share the profit, right? We have to share the profit. The profit of 2011 is what? 18,000. 80,000 into B's share. B's share is how much? When the new partner came, B's share became 1/3. It was 1/2, now it is 1/3. So 1/3 into what is that profit? 18,000. So we'll get B's share of profit, that is 6,000. Now total both the side, again we'll get 12,700, that is credit side is greater now. We get a balancing figure that we have to brought forward to the next year. Again there is a mistake in the dates here. Make it 2012. And 1st January 2012 we show by balance brought on 7,900, which we brought forward from the previous year. Okay. Then we have to show what? Drawings. Again there is no restriction, there is no change in his withdrawals. 400 into 12, do it, and we'll get 4,800 on 31st 12 2012, right? Okay, then we have to share the profit. The profit for the year 2012 was 24,000. 24,000 into B's share. Now what is B's share in 2012? B's share became 5/12, right? So 5/12 into 24,000 you have to do, and you will get 10,000. Total both the side you will get 13,100 as a balancing figure of 2012. Now let's just brought forward that amount to next year. That is, even though he said that in 1st January 2013 he got a job outside the partnership firm. So on 1st January 2013 B was informed that he got a job somewhere else, full-time job. So now he have to do some procedures before he is leaving, right? So it took an entire year for the procedures to end. Let's just assume like that. And it was on 31st December 2013 he retired. Let's just assume like that. So in 1st January in 1st January 2013 to 31st December 2013 he's still there as a partner. Okay, he's still there as a partner in the firm. So we have to also show that year in the capital account. Fine. So that is what we're showing here. So we have just brought forward that balance which we got 13,100 to the 2013. Let's make it 2013. Okay. So balance brought on 13,100. Fine. Is he going to withdraw anything? No. His withdrawal limitation became nil. He cannot withdraw anything in this year. So there is no withdrawal here. Fine. Then what it is that we have to share the profit and losses. So profit he got, that is the profit of the firm was in 2013 was 28,896, and his share became how much? Okay, his share became how much? That is the share which is going to remain in the firm is only what? 1/4. So only 1/4, that is 5/12, 1/4 is 5/48. So 5/48 will be B's share of profit on 2013. Rest of the share he surrendered, right? And that share was distributed among A and C, which we already calculated here, right? So 5/48 is now the share of B in the year 2013, and that is in the year 2013 they got a profit of 28,896, and B's share is 5/48. which we already calculated while we read the question, right? So just do it like this and we'll get 3010 as the amount. Now we have already calculated goodwill also. B's share of goodwill, that is 16,000. Now we have to also show, that is we have already learned the theory of retirement of partner, that the retiring partner should be given his goodwill, right? The partnership firm has to give his goodwill. Okay, so retirement, at the time of retiring, we have already learned that the retiring partner is also eligible for share of goodwill of the firm. So we already found the share of B, that is a person, that is a partner who is going to retire, right? So we already found the share, his share of goodwill. Now that is what we are going to write here, 16,000, which we already found here, 16,000. Okay, then just total both the sides. There is nothing in the debit side, so just write the total of credit side. Same in the debit side, that's 32,110 and 32,110. So again, let's find what is a loan account. That is, the balancing figure will be loan account, right? From 2013, 31st 12 2013, this B is going to retire. So we have already learned that there will be no balance for capital in the name of B. There will be only loan account. You have to transfer that amount which we got as balancing figure of the capital account to B's loan account, since B is going to retire from the partner, and this is the amount which the partnership firm has to give B. 32,110 have to be given to B by the partnership firm, and that is all. So that's it. This is the question, illustration number 17. And please, and I'm again telling you this, if anyone knows the the concept of this portion means from here to here, this portion. If anyone knows the clear-cut explanation of this portion, please comment down okay, so that it's going to help a lot of people. Fine. So that's it, illustration number 17. I hope this is clear to you. Now let's just go to illustration number 18 also. P, Q and R were equal partners. So their profit sharing ratio is 1:1:1. R retired on 31st March 2013. Okay. The balance sheet of the firm as on 31st December 2012 is shown here. Okay. Okay, fine. Everything is given. On 31st 3/2013, the following adjustments were considered. Buildings were appreciated by rupees 18,000. Appreciated means the value of buildings increased. 18,000. So 14,000 is the current value of building, and by 80,000, that is, just add this 80,000 with 40,000, and that amount we have to show in the balance sheet. This 80,000 we have to show in the revaluation account. Book debts were considered good. That is, debtors were there was no bad debts. That is what they are. There was no bad debts. That is what they are mentioning here. That is, there is no need to show. There is no need to create provision for debtors, because everything was good debts only. There is no bad debts, and there is no expectation. There is no anticipation of bad debts also. Investments were considered worth rupees 4,700 and stock was valued at rupees 9,400. So investments were considered worth rupees 4,700. That means investments at cost they have shown us 5,000, and investments were considered worth rupees 4,700. So that is, now it was shown in the balance sheet 5,000. It is now 4,700. So the difference amount is what? 300. Stock was revalued at rupees 9,400. Stock is of 10,000 here, and it was the values decreased to 9,400, and the difference amount we have to show in the revaluation account. Revaluation account. Goodwill was considered equivalent to the average annual profits of the last 3 years. So we have to find the goodwill. We have to find the average annual profit of the last 3 years. We have to take the past 3 years profits and then average it. Okay. As share of profit up to the date of his retirement was calculated on the basis of average annual profits of the preceding 3 years, which were, and they are providing us with the profit of 3 years so that we can calculate goodwill. Show the journal entries and prepare the balance sheet immediately after our retirement. Okay, I think this question is fine. Let's just do this question. I think it's a normal question. So the first thing, just take this 8,000, 9,000, 10,000, add these together. Then in order to average it, since we have given 3 profits, we have to divide these 3 with 3 in order to get the average. Okay, so there's 8,000 plus 9,000 plus 10,000. We get an amount, divide by 3, we'll get 9,000. Fine. And please note this also, goodwill in the balance sheet that is provided in the question is 18,900. Here they are saying what? Goodwill was considered equivalent to the average annual profit of the last 3 years. it is goodwill is already equivalent to this 9,000. That is what they are saying. We found average annual profit of last 3 years, that is 9,000. And they are saying goodwill is equivalent to this 9,000. That is, goodwill is 9,000. Now the goodwill is 9,000, but in the balance sheet they are showing us 18,900. So what we have to do? The value of goodwill decreased, right? So that difference amount you can either show in the revaluation account, or you can also show that in the partner's capital also. That we have already explained in illustration number 16 or 15, I guess, right? In the previous video I have already discussed that. We can either show this in the revaluation account or in the partner's capital account. Fine. So here this shall be shared. Here they are showing 18,900 minus 9,000 is equal to 9,900. Okay, fine. In this question they have asked us to show journal entries as well as to prepare the balance sheet also. Okay, fine. Okay, now let's get to the solution of illustration number 18. So the first thing, let's follow our study mat. Okay, so the first thing this says about valuation of goodwill. So in our study mat, in the additional information, they have told us that goodwill was considered equivalent to the average annual profits for the last 3 years. So they have also given us 3 years profit, last 3 years profit. So they have told us to average these annual profits, and that amount, the average annual profits amount, is equivalent to goodwill. So just average these three, that is, add this first, 8,000 plus 9,000 plus 10,000 divided by 3, and you will get that average annual profit. Fine. Okay, this is average annual profits. That means it is for 12 months. Okay, so this is the average annual profits. Okay, and it is said that goodwill is equivalent to that. So 9,000 will be the value of goodwill also. Okay, but there is a problem. In our asset side, have shown as a goodwill which is of 18,900. Now the goodwill is valued at 9,000 rupees, which we found right now. Okay, so what is happening here? We have to, there is extra goodwill which is there is extra goodwill in the balance sheet, right? So we have to write off that extra amount. So decrease in value of goodwill is equal to 18,900 minus 9,000 is equal to 9,900. We could either write this off or we can also write it in the revaluation account. Okay, when we write this off, what will happen? Our partners' capital will be debited, right? So this shall be shared among all the partners in their old ratio. So first, let's go with our first journal entry. The first journal entry is also about goodwill only. So I have already told you that we can write this 9,900 in two places, either in the capital account or you can write it in the revaluation account. So we can only follow any one of them. In our study mat, it is shown written in the capital account. That is, we are writing this off. Okay, we are writing this 9,900 off. Okay, so that is the first journal entry. You'll be able to see here, right? P's capital account debit, Q's capital account debit, and R's capital account, and we divided this 9,900 equally. That is 1:1 is a profit sharing ratio of PQR. So 9,900 into 1 by 3, 1 by 3, 1 by 3. We'll get this portion, that 1,300. Okay, so this is the first journal entry about. Okay, the next point they are saying is about what? R retired on 31st March 2013, that is after 3 months from the date of the last year intake. That is, when you see here, the balance sheet which they have given us is of 31st December 2012, and R retired on 31st March 2030. So how much months have passed from 31st December to 31st March? 3 months, right? After the closure of this final accounts, 3 months after this closure of final accounts, only R has retired. So there is a policy what we used to do, like the R should get, the retiring partner should get the profit till he was there in the partnership firm. Okay, we have to give, the partnership firm has to give him the profit till the time which he was there in the partnership firm. Okay, so 3 months was 3 months extra was there, R was there in 3 months extra. So you have to also find the profit for this 3 months. And the other thing, that is 31st December 2012, they might have already shared the profit. They might have already prepared the profit and losses and balance sheet and all, and they might have already shared the profits till 31st December 2012. Now we have to just find the profit of these 3 months, because R is the one is going to retire and you have to get the profit till the time he was there in the partnership firm. So we have to find what? We have to find the 3 months profit. So that is what we are doing here. So first thing is that we have already given the estimated profits, right? Estimated profit, we already averaged it for the valuation of goodwill. We already did the we already averaged the annual profits for the purpose of finding valuation of goodwill. So we can just take it, since the same calculation is going on the second point also, they have not shown the same thing twice. Okay, so you can just refer here. The same thing is happening here. That is, we just average these three profits, and we got 9,000. What does this 9,000 mean? This 9,000 is average annual profit. Annual means 12 months, right? But we need profit for 3 months, right? So we are just taking this 9,000 and calculating profit in a proportionate basis. We know it's just an assumption. It is not the exact profit. Okay, it is just an assumption. In order to divide, in order to apportion that profit amount to R, we are just taking the last year's, like the average annual profits of last 3 years. Okay, then we are taking only what we are only want 3 months profit. Annual means 12 months. So this 9,000 is of 12 months. So 9,000 divided by 12 into, for how many months do I need this profit? 3 months, right? So 9,000 divided by 12 into 3, you will get 2,250. So this 2,250, is this the portion of R? No, because this is just the assumed or estimated profit of the firm for 3 months of the firm. Now we have to find R's portion in it. So R's portion is what? 1:1:1. So 1 by 3, right? That is the R's portion. So 2,250 into 1 by 3 have to do, only then you will get the R's portion. Fine. So we got R's portion, that is rupees 750. Now what we have to do with the 750? They have already told us in our study mat that we have got 2 options. First option is we can just the continuing partners. We can debit the continuing partners capital account. That is, continuing partners are P and Q, right? So P and Q are going to be there even after our retirement. So P and Q are continuing partners. So we can just debit their capital accounts. That is, P's capital account debit, Q's capital account debit to R's capital account. Okay, like that. Or you can also do something else. What is the next option they are telling about? Profit and loss suspense account may be debited. So you'll be asking me, what is this profit and loss suspense account? This profit and loss suspense account is an account where we actually write the estimated profits. So let me tell about it now. When a partner, this account can be prepared either the partner is retired, when either the partner is retired, or in the case death of a partner also, at any time. It can be recorded before the end of the reporting period. Okay, now it is a temporary account created to record the estimated profit for the current financial year during the reconstitution of the partnership firm. When a partner is retiring, there is some changes happening in the partnership firm, right? So we have already learned that it is we calculated profit for 3 months, right? How do we calculate it? We calculated the profit of that 3 months on the basis of average profit. Like we calculated it on the basis of average annual profits, because they have given us in the question 3 years profit. So we just averaged it, and then on that basis only we found the profit for these 3 months. That is, we took that basis. It was actually what? It is actually just our assumption. We are assuming that we'll get to have 2,250, because we got an average of 9,000 in the in 12 months of a year. So we are just assuming that we'll get 2,250. So this is actually what? It is an estimated value of profit, right? So the proportionate profit, this is, we found it in a proportionate basis, right? Because like 9,000 is for 12 months, so we need a value which is equal to 3 months. So we just divided 9,000 with 12 and multiplied it with 3. This is just a proportionate, right? Proportionate profit we found. So it is recorded. This kinds of proportionate profit thus found is recorded in the profit and loss suspense account. The balance of the profit and loss suspense account is transferred to the balance sheet of the new firm, or after the retirement of that partner, it is shown in the in the balance sheet, in the new balance sheet. Fine. So that is simple. I hope this is clear to you. So it is used to write those values, estimated value of profits. So this is 2,250 we found, and we found what is the share of ours in it, and we got 750. This will be our journal entry.
Write them in the suspense account. And then we'll show it in the new balance sheet. That's all. Hope this is clear to you. So the next entry will be based on this. Let's see that. Profit and loss suspense account debit to ours capital.
Profit and loss suspense account rupees 750. Don't forget. Next, the other point they are talking about is what? Investment. Yeah, investment. I have already told you that investment at cost is of rupees 5,000 and the market value of investment is of rupees 4,700. The loss is of 300, right? 5,000 minus 4,700, you will get 300. Now, this 300 could be taken from this investment fluctuation fund, that is 1,200. Okay, we are taking 300 from 1,200. Now, I share this investment fluctuation fund directly with the partners, or you can also first credit it to revaluation account, and from revaluation account you can then from revaluation account you can share it with the partners. Okay, so that is the method which our study mat has followed. I will show you the clear differentiates between the journal entries of this investment. Okay, now let me explain the portion of investment fluctuation fund. So those who are watching, first make sure that you have already watched the video where I have already explained about the logic of investment fluctuation fund, and then only you will be able to understand what I am going to say. Okay, what I am about to say now. So in illustration number 18, you will get to see that investment fluctuation reserve, which is shown in the liability side of the balance sheet, is of rupees 1,200, and on the asset side it is shown that investment at cost is of rupees 5,000. And in the additional information they have provided that now the market value of investment is 4,700. So we already know what is the first thing I have already explained in the video. First we have to calculate what is the value of or amount of loss. So 5,000 minus 4,700, we will get 300 as the loss, and we have to take that from the investment fluctuation reserve. We already have 1,200 in the reserve. Okay, so it's fine to take from this from this reserve 300, and then we can share it among the partners, and that is what I have explained in the video. The video which is solely for the purpose of making you guys understand investment fluctuation reserve. Okay, so in that video I have explained like that only. The concept have no changes. It's just that the journal entry may get you a little bit confused. So I have thought to explain this bit more clearly to you. So now let's see how it is actually happening in the investment fluctuation. This is the kind of entry which I have told you that in the similar scenario when came, I have told you to pass this entry, right? The investment, how it is going: investment fluctuation reserve account debit 1,200. This is the amount of reserve or the amount which is there in the fund. Okay, then to investments account, we'll write the amount of loss, that is 5,000 minus 4,700 is rupees 300. Okay, then the rest of the amount, that is subtract this 300 from this 1,200, and the balance money is 900, that is to be shared among the partners. And this is the logic which I told you to follow in that video. Okay, so the logic has no differences. So it's just that like I said before, journal entries may get you a little bit confused. So now let's see how our study mat is showing. So in order to see how our study mat is showing, I am making the same entry into another entry. The same one can also be passed like this also. Okay, in this entry you'll be able to see in illustration number 6, I guess. Okay, of our study mat, you will be able to see this kind of entry. Okay, you can either pass this or this. Fine, that's why I have written over here. Okay, so let's see. This same entry we can pass this like this also. Let's see how it is. Investment fluctuation reserve. We wrote that investment fluctuation reserve account debit 900 is what we are going to debit. How? 1,200, and subtract this 300 directly, and the remaining amount will be written as 900. Got it? Okay, we are just eliminating this investment thing and just subtracting this 300 directly from 1,200, and that amount is returned straight to investment fluctuation reserve account. Fine, and then it is to be shared among the partners like we did before. 300, 300, 300, 900 into 1 by 3, because they are equal partners, 1:1:1. Fine. Okay, so this can also be passed this way. Now we can make this entry into 2. We can just split this entry. This entry we can split into 2. How can we split? That is how our illustration number 18 has done in our study mat. See, the same entry I have split it to 2. Okay, I have split it to 2. That is investment fluctuation reserve account debit to revaluation, and revaluation account debit to P's, Q's and R's capital. That's what I have written. I just splitted this entry. Here I clubbed that entry, 2 entries clubbed, or you can also write this 1 entry in order to make it simple. In our illustration number 18, they have shown this entry. That is buildings and other assets are also shown, and along with that investment fluctuation fund is also debited 900, and then credited to revaluation account 900, and from revaluation we are just sharing it among partners. So everything is same only, so don't get confused. So I just thought to make it clear for you. Fine, so that is it. Now what is there? Now we have to focus on this buildings. Buildings were appreciated by rupees 18,000, right? 18,000, that is here. Buildings is of rupees 40,000. It is appreciated by 18,000. That means 40,000, add this 18,000 with this 40,000. That amount should be shown in the asset side of balance sheet of our new balance sheet. Okay, that should be shown in the asset side of our new balance sheet. So what is this 80,000? 80,000 is actually the difference amount. That is, this 40,000 is increased by 18,000 means what? We have to include this 80,000. We have to add this 80,000 to this 40,000, and then only that amount shall be shown in the balance sheet. So this 18,000 is actually the difference, right? So they are directly given us a difference. So this can be written in the revaluation account. Okay, that's it. Now book debts were considered good. That is another thing which I have to tell you. Book debts were considered good. Here you see debtors is of rupees 10,000. Book debts means rupees 10,000. This entire 10,000 is considered to be good. Here in the liability side, when you see, you will be able to say provision for bad debts rupees 800. Actually, we used to write this provision for bad debts here only. Debtors minus provision for bad debts less 800. We will get what? 9,200 we will be getting. So right now in debtors is actually 9,200. But the book debtors, what, still 10,000 is a book debt only, but this 8,000 instead of lessing here, they have just shown it in the liability side. Both have the same effect, right? So provision for bad debts rupees 800 they have given us in the liability side, but in the addition formation they are telling that the book debts, that is rupees 10,000 is actually considered good. That is, there is no bad debts. Debtors came and paid the amount at the right time, will pay the amount, they have got the guarantee or something. So they are just saying that there is no bad debt, there will be no bad debt. So there is no need to show the provision for bad debts in our new balance sheet. So what we have to do? We have shown provision for bad debts in this balance sheet, old balance sheet. And when we are preparing a new balance sheet, there is no need to show this provision for bad debts in the liability side. What we have to do? We have to cancel it. So when we made this provision for bad debts, it is actually a liability, right? So we might have credited in a journal entry. Now we have to debit it, right? So only then will this provision for bad debts will get cancelled off, right? So we have to debit this. That's it. So the next point, important point. That's the next important point. Next is stock. Stock is of rupees 10,000 and it is valued at 9,400. That is, 10,000 became 9,400. So that difference amount should be shown. The difference amount will be rupees 600, right? That should be shown in the revaluation account. So that's it, I guess, right? So they have shown this buildings, investment as well as provision for bad debts in one single entry. That is it. So buildings are appreciated, right? So assets are increased. So asset is debited here, buildings account debited. Then provision for bad debts is actually liability. But since the additional information said that there is no need to show provision for bad debts, that is book debts is actually considered to be good. So we have to cancel this liability. So we are just debiting it, right? Liabilities have to be debited if you want to decrease it, right? So that is what we have done here. Then comes investment fluctuation fund. Investment fluctuation fund I have already given you how it became. I already explained you. We can either show it in two ways. In this study mat, the study mat I followed how. That is, first, this investment fluctuation fund is actually credited to revaluation account, and then from revaluation account it is shared among the partners. So that is what we have actually shown here. Wait, next. So this is the journal entry where they are compiling all these three. Next comes stocks. So revaluation account debit to stock 600 rupees, 600. Okay, fine. That's it. Okay. Okay, so stock has to be shown different. Stock has to be shown in a different journal entry because in case of stock it is actually decreasing, right? So so stock have to be shown like this: revaluation account debit to stock. Fine. Then after preparing a revaluation account, I would suggest you to prepare a revaluation account. Still, if you are if in the question they have not asked us to prepare a revaluation account, then it's fine. But still, it would be great if you have an image of the revaluation account of that particular question, so you'll get to understand if it is profit or loss. Okay. So that's it. So profit is what is coming in the revaluation account. So we are just sharing it among the partners in equal basis. So that is what is shown here in this journal entry. And then what is there in our old balance sheet? They have shown us a general reserve. If there is any reserves remaining, we have to share it among the partners. So that is our policy. So that is the next journal entry where we are just sharing this journal reserve among the partners. Okay. Then what? Then for the last journal entry, you have to prepare a partner's capital account. Let's come here. For the first thing we are writing in a partner's capital account will be by balance brought down. That is this balance which is shown in our liability side. 30,000, 20,000, 20,000 is written here. Okay, fine. Then what? Profit and loss suspense account. In this journal entry, we have actually credited R's capital, right? So we have to show that in a partner's capital account under R only. Okay, because we have only credited R. So we have this 750 should only be shown under R. So profit and loss suspense account rupees 715. Fine. Then what we have already shared the revaluation profit which we got, right? So that also have to be shown in the partner's capital, and that is the next thing we are showing. That is 6,366, 6,367, 6,367. Fine. Then what is that? Journal reserve. We have already shown the journal entry here. So journal reserve 4,000 was there, and it is shared among the partners like this. So that's same we are going to copy it here. Fine. Then what is coming on the debit side? Debit side, what will happen? Goodwill account written off. Here, don't forget about the first journal entry we have written. We have actually debited all the partners' capital account, right, in order to write off this goodwill, right? So we have to show that in the debit side of the partner's capital account. That's what it's shown here. After this total both the side, you will see that credit side is greater than the debit side, and just write the same totals here, copied here. Then the balancing figures of P and Q will be written as to balance carried on, and it should be shown under capital in the balance sheet. P and Q 34,400, 24,400. Fine. Then the balance figure of R should be shown in R's loan account, because this 25,150, which is the balancing figure of R's capital, have to be transferred to R's loan account, and this is to be shown on the balance sheet saying R's loan account only 25,150, because R is going, and this particular amount is should be given by our partnership firm to this person, the retiring person. So that is why we are showing it in the liability side. Fine. Then just prepare the balance sheet. Sorry, before that you have to pass that journal entry, right? So first just pass that. So R's capital account debit to R's loan account, that will be the journal entry. 25,150 is the balancing figure which we got. Fine. Then after that, after everything, we have to prepare our balance sheet. Okay. So the balance sheet, what will be the amount of goodwill? We have already written off the extra amount. So the value which will be shown in the balance sheet will be only 9,000. Okay. Then buildings. Buildings were actually first. Buildings was actually 40,000, but in the additional information they have told us that it is actually appreciated by 18,000. So we have to add this 80,000 with this 40,000, and that amount should be shown in the balance sheet. Fine. Asset side. So that is 58,000. We have already shown it. Fine. Then investment cost will be shown only at cost. That is 5,000. There will be no change in it, because this is the amount. Investment at cost is the amount which we actually bought this investment. So there will, like, once we purchase, we cannot actually change the past, right? It's actually sunk cost or something. Okay, so sunk cost cannot be the costs which have already incurred or which have already which already happened to us cannot be changed, because it already happened. So investment cost is rupees 5,000. We cannot change that. Then comes stock. Stock is actually changed to 9,400. 10,000 to 9,400. So 9,400 is shown here. The difference amount shall be shown in the revaluation account, that is rupees 600. Fine. Then comes debtors. Debtors, what is happening? In the old balance sheet, the value of debtors was actually 9,200, because there was provision for bad debts, right? So they have told us to cancel that. So we cancelled it, and now debtors again became 10,000. Okay. Then what's there? Cash at bank, there is no change in it. In our old balance sheet also, it is shown as 10,000 only. So we're just writing it down. See. Then the extra thing, don't forget about this profit and loss suspense account. We have to show it under the asset side of the balance sheet. Profit and loss suspense account 750. Fine. Here in the liability side, I have already talked about capital and also R's loan account. Fine. Next comes investment fluctuation fund. In the liability side of the investment fluctuation fund, we will write that liability which came. Okay, so this rupees 300 will be shown like that, because in this case 5,000 minus 4,700 is the loss. For the new balance sheet which we are preparing, we have to write this loss in the under investment fluctuation fund. In the liability side of the new balance sheet, we have to write this loss which incurred to us under investment fluctuation fund. Okay, so that is what we are doing here, rupees 300. I have forgot to tell this in the video. Sorry about that. Okay, so rupees 300. Okay, this is actually applicable to all questions. So the loss should be written in the liability side of the balance sheet as investment fluctuation fund. Okay, then comes trade creditors. There is actually no change in trade creditors. We are just writing it off the same. Okay, we are just copying it the same. Okay, 70,900. Then what we have to do, once we just total both the sides, you will see that both the sides are tallied. So this is how we do illustration number 18. I hope this is clear for you. Fluctuation fund is having a slight similarity with worksman compensation fund. I think worksman compensation fund I have already shown you. So this one thing you have to keep in your mind, that is, this is an extra point. The lows which we occurred in this investment and market, in this investment fluctuation fund scenario, there is something you have to keep in your mind. You have to write, this is the old balance sheet. In the old balance sheet, they have shown us 1,200 is the fund. Fine. In the new balance sheet, what we have to write as investment fluctuation fund, we have to write the lows which we had in this year. That is, in this case, 5,000 is the cost of investment and 4,700 is the market value. So when we subtracted this, we got rupees 3,300 as the loss. So this loss have to be shown in the next year's balance sheet under saying investment fluctuation fund. So that is what it actually done here. There is no other questions of investment fluctuation fund till now I have done, only illustration number 6, but in that question they have already asked us to prepare journal entry. So I cannot show you that, but it is actually similar to worksman compensation fund. Okay, if that concept is okay to you, then it will be okay. Then this concept will also become easier for you. Okay, so that's all. I hope this video is helpful for you. Thank you for watching and work your studies.